Hello and welcome to the Saturday Summary for January 18th, 2014, your weekly summary of market and economic news for annuity and life insurance professionals. I'm Jonathan Illig for The Biz. Be sure and click on the subscribe button next to this video to have this summary delivered to your inbox and receive our special offers. Now, as always, our Saturday Summary begins with the year-to-date and rolling one-year point-to-point results for the major indexes. As the headline says, the S&P 500 and the Dow remain negative for 2014 to date, but the NASDAQ Composite and the Russell 2000 are up about a half point for the year so far. For all the indexes, the rolling one-year point-to-point performance remains very high, but we are starting to see those figures slowly decline. Now, the question is this relative flatness of the indexes a sign of a market top? Many analysts think so, but time will tell. If it is a top, then there are only two directions in which the markets can go, either down or sideways, and neither of these directions justifies the risk of losing the gains made in 2013. There is still time to take gains and the safety provided by indexed annuity and indexed life insurance contracts. As you'll see in this week's articles, the warnings of a correction or a crash are growing louder each week. Take action now to protect your gains while there's still time, as declines tend to happen fast. Now, a word of warning for our clients and prospects. It will soon be 5 years since the March 6, 1995 low point in the S&P 500 index, which marked the financial crisis. Now, this is going to allow mutual funds to drop those 2008-2009 loss figures from their 5-year average returns. Remember, the S&P 500 lost nearly 39% in 2009. Therefore, the 5-year average returns will only reflect this Fed stimulus-fueled bull market that has seen the S&P increase 170% since March 2009. Now, these mutual fund figures will be accurate. Just remember your history. Now, I have a couple of charts to make you go hum. This chart here has been making the rounds of Wall Street for several weeks. Now, as you can see here, the chart compares the pattern of the rise of the Dow Jones Industrial Average over the past couple of years, that's the one in red, Dow Current, with the pattern of the Dow Index from 1920 to 1930 as it approached the crash of '29 and kicked off the Great Depression. That's the line there in black. Okay. Now, this is not scientific, but one has to admit that the similarity of the patterns is somewhat astonishing. Makes you go, Next up, a comparison of retail sales to disposable income. Now, with all the Fed's hype about the recovering U.S. economy, how does one explain the data presented at this chart? The blue line shows the rise and the fall of the year-over-year retail sales in the United States, while this red line shows the rise and fall of disposable income per capita, both for about the past 20 years. Now, the crash of both retail sales and disposable income during the financial crisis is highlighted in that red box. Compare that to the decline of both retail sales and disposable income in 2013 to present. Now, remember, the U.S. and really the global economy is highly dependent upon consumer consumption. So what might this data indicate about things going forward, particularly to support the increase in corporate revenue and profits to keep stock values rising? Like I said, makes you go, Next up, our quotes of the week. Again, we bring you 4 this week, but I really like these 2. This first one here, I just love this thing. It's by a gentleman by the name of Richard Fisher. He's the president of the Dallas Federal Reserve Bank, and he's a new voting member of the Federal Open Market Committee. That's the group that sets interest rates, determines all the stimulus and everything. What do you have to say? You can see it here. Investors are seeing the world through beer goggles. Things often look better when one is under the influence of free-flowing liquidity. Beer goggles, gotta love it. What he's talking about there is all this Fed stimulus, that liquidity. And as I mentioned, Fisher's going to be a voting member of the FOMC this year, and he is in favor of ending stimulus as quickly as possible. Let's move on. Our next quote is from Sean Tully. Sean Tully is a senior editor-at-large for CNN Money, who wrote this week, as we can see here, Wall Street has never been more challenged to create arguments that it's a good time to buy stocks. It's performing an amazing feat of salesmanship. And he says, don't believe it, investors. Let the lessons of history and real market math be your guide. Great stuff to share with your clients and with your prospects. Now, we're running out of time, so let's do a very quick overview of this week's articles from the financial press. First one up, stocks are starting to look overvalued. This is quoting a Goldman Sachs analyst and is predictive of a possible correction. Similar note is sounded in this article from the New York Times entitled, A Market Streak Has Ended, but the Echoes Haven't. Moving forward, 2 additional articles sounding the alarm of a pending market correction are this one here, Recovering Economy Could Rein in the Bull Market, experts say, and Mark Faber, we are in a gigantic asset bubble. Now, I love and agree with Faber's comment in this article where he is talking about artificially low interest rates for years, stating, you penalize the income earners, the savers who save, your parents. Why should your parents be forced to speculate in stocks and real estate and everything under the sun? Gotta agree with Mark on that one. I've been sounding that alarm for years. Moving on, there's several other great articles this week. We're running out of time right now, so that's your Saturday summary for Saturday, January 18th, 2014. Now remember, subscribe to this to have it delivered into your inbox, both the video version as well as the written version, and get our special offers. Just click on the subscribe button next to this video. Thank you. We'll see you next Saturday.